Hey, it's Patrick Moore with Ironclad Wealth Management here with the next video in our series on how you can save taxes when you're getting ready to sell your small business. And today's topic is a little bit of a variation on the last video we did on installment sales. Today we're going to talk about structured installment sales, which basically, if I had to summarize the whole video, is the biggest risk of an installment sale is that your buyer doesn't pay you. This is a way that solves that problem. So before we dive into this, just as always, general advice. If you think this works for you, I hope it does. I hope you learn from this, but you need to take this information, speak to your own advisors to really verify that the numbers work for you and that you're not overlooking any risks. So, why should you consider a structured installment sale? Well, basically, it's the same tax benefits as an installment sale, where you spread that $10 million payment over 10 years. You put more money in the lower tax brackets, and when you do that, you save money. However, when you do the installment sale, you got a good chance, especially if it's kind of somebody who doesn't have the money, that they may not be able to pay you. So if you like the tax side, but you don't like the buyer side, this solution allows you to basically get an upfront payment and still spread the taxes over the remaining life of that installment note. So how does it do it? Well, the big thing you have to know is you can never take control of that money. If you take control of that money, you've got what's called constructive receipt, and you're going to get taxed on the full $10 million. However, the way this works is that as part of the sales contract, the buyer has to come up with the example where it's a full $10 million. It will say, okay, I'm going to pay the seller over 10 years, but I'm going to make a deposit with an intermediary, and then the intermediary will be responsible for making those payments. So what happens is if you look at the little diagram here, your buyer makes a deposit with a qualified intermediary. The intermediary pays you over 10 years. You've still got a promissory note securing that. You sell the company still. And so you have, through the intermediary, not control, but full receipt of the full $10 million, and then you get it over 10 years. So by simply inserting that step and a lot of additional legal paperwork, you can spread those taxes over 10 years. So why do this? Why do this? Well, if you do this with a $10 million sale, this is a $9.5 million capital gains version. It's the same version from our installment sale. If you do this with no interest, you would actually save or reduce the amount of money that you have in the top capital gains bracket by about $5.4 million over that 10-year period. So if you look at this, you actually get almost $1 million in the 0% bracket, which means you're just getting about $1 million completely tax-free. You get $5 million in the 15% bracket and 20% in the about 3.4 million in the 20% bracket. So when you look at this, that's all you're doing. You're spreading it out over 10 years. It's the same exact scenario as an installment sale, but you've got the added security of having all of the money up front. So what does this look like? Well, this is the same example from the last page. We got a sale price of $10 million, basis of $500,000. That's a husband and wife duo in Georgia. They run an engineering firm they're looking to sell. Well, if we look at this, you can see that if they do a lump sum sale, they'll receive about $7.6 million after all of their taxes are paid. If they do an installment sale, they would receive $8.1 million. That's about $500,000 in tax savings purely by moving where that money is in the tax brackets. And then a structured installment sale, once again, to contrast it from our previous video with installment sales, I think I had like an 8 or 9% interest rate on that video. In this, you can see that we only have a 5% interest rate, and that's because your money is much safer. Those intermediaries are investing in much safer instruments, and they're not a small business buyer. They've got all the money. They're going to invest in safer things, and you're going to receive a lower interest rate. So at a 5% interest rate, you receive about $9.9 million after taxes, which is still more than the net proceeds from a lump sum sale. Now, if we discount those cash flows by a 4% interest rate, which just kind of adjusts you or just the value for you for not having all that money up front, not being able to earn interest for those 10 years on the full amount, the present value of that interest or installment sale at 5% interest is still higher than the upfront sale. So if you look at this, for this family, if they are somebody who just wants their money to be safe, they're not trying to go out and get a 10% return on the money every year, they're conservative investors, this is something that can be pretty attractive. And remember, it doesn't have to be the full amount. Maybe they do want a little bit up front. Well, they could take it. Maybe they take $4 million, $5 million up front and then spread the rest over 10 years. That's a possibility. So what are the setup requirements to do a structured installment sale? Well, you do have to work with a qualified intermediary. You need to make sure that person is reliable because obviously they'll be holding your money. But when you work with them, there will be specific language related to the installment sale and how it needs to be structured put into your purchase agreement and promissory note. So you still have to do the same installment sale requirements. You got to file Form 6252, and you can't access the funds during the term. As soon as you access them, you get constructive receipts. So really, unlike some of the other things we've talked about, it's a little more complicated than just an installment sale, but it's much easier. It really doesn't have any timing requirements like QSBS, like an ESOP, like a charitable remainder trust. It's something you can set up when you're staring down the barrel of a sale and you're trying to figure out what you need to do. Now, what happens and what are some of the drawbacks? Well, if you are deferring gains more than $5 million, you will have some additional interest penalties assessed to you by the IRS over $5 million. Another thing is not all assets qualify. These are the same rules as a regular installment sale. If you're selling inventory, if you're selling accounts receivable, if you have property subject to depreciation recapture, all those taxes will be due year one. Once again, you're locked into the contract, and while you're replacing buyer risk or you're eliminating buyer risk, you are replacing it with a little bit of intermediary risk. So you got to make sure that the intermediary you use is reputable and you're comfortable with your money sitting with them. Now, typically, these are like large insurance companies, so most people are fairly comfortable with them, but you do need to vet and make sure you're not going kind of with an unknown person when you're looking at this. So those are the main drawbacks of this installment sale. I think another thing that it's hard to quantify, but is a potential drawback is, you're locked into earning 4 to 5% interest over whatever time period you choose. If you're somebody who's an aggressive investor that thinks they can make a lot more money than that, then maybe this isn't right for you. I don't know if it's a risk or drawback. It just kind of changes if it may be appropriate for you. So in that vein, who should use this strategy? I think this is best for people who are going to be in lower future tax brackets, meaning if you're trying to defer your income into future years, if you're still going to have $1 million or $500,000 coming in from other sources, there's really no benefit to doing the installment sale because you're going to be in those high brackets anyway. So you might as well just take your money, take your lump sum, take the lump of taxes and just kind of eat it and just move on and reinvest in other places. But if you are going to be in lower tax brackets, if you don't have much other income and you're going to go from making $1 million this year to just making $500,000 in an installment sale, it really does look pretty good when you look at the numbers. Other thing is risk averse sellers. Like I said, these structured installment sales are conservative investments, 4 or 5% interest. If you're somebody who's okay with that and you'd be looking for that anyway in the market, this thing may be a pretty nice fit. The other thing is you are going to get income, not a lump sum. So if you got the plan to buy a $5 million house when you sell your business, I don't know if that's smart. I'm just saying if that's your plan, hey, you might not want to do this because you can't get all the money up front. So how do we help? Well, we model the impact and look at this and other strategies as this video series goes. I think we've got like 7 different tax strategies that we're looking at and kind of giving a quick overview on. We look at these from your perspective. I don't represent the structured installment sale companies. I couldn't care less if that's what's best for you. A regular installment sale is best for you, or just taking the lump sum, paying the taxes, or one of the more complicated tax strategies is right for you. I don't care. My job is to figure out what you need, figure out what the potential risks are for you, and then identify and model the impact of each strategy. Once we find that, we work with CPAs, attorneys, or in this case, the qualified intermediary who's going to hold your money, and we make sure that things get done the right way. So if you actually want to put a tax efficient sale together, reach out, schedule a call. We do a 15-minute intro call just to make sure that we can help, because if we can't help, we'll tell you. The best thing to do, though, is to schedule a call before signing your LOI, and in the best worlds, to get the best bang for your buck, it'd be great to do it a year or 2 or even 3 years before you're considering selling your business. So the earlier the better. I hope this helped. I hope this is a strategy that, if it interests you, I hope it's something you haven't heard before and it's something that you could look into a little bit further. But we will continue the series on with our next strategies, and I hope you have a good rest of the day.